Okay, let's answer some questions from Sunday's market outlook, and a lot of them relate to yields and TLT. And yes, it has been ugly. I will admit to that. One question for the applied series: are you planning? Would you consider making a video about how to set up a quality tilt portfolio? I really like the Bill Ackman approach. Would love to see how you'd set it up systematically. What company indicators to consider in equity screening? So this job is mostly done for you. There are ETFs that track a whole bunch of factors. I'm just going to put F as the factor, and whatever factor that you want. But there are ETFs that already track these factors. Let me just do something here for a minute to get my crosshair back. And for the ETF, you can look at what their inclusion criteria are. They will list what their inclusion criteria are and the indicators that they're looking for, and it has a list of all the components. There's your starting list, right? Now, in each of these ETFs, you're getting the beta for the market, so your first factor is the market, plus you're getting some sensitivity to some particular factor, whether it be momentum, whether it be quality, whether it be size, whether it be value or growth. But there are lots of ETFs that already track factors. So you may want to Google factor ETFs and have a look at, there's probably a number of quality factor ETFs. Have a look at their inclusion criteria and have a look at the constituents of the ETF, and you have a list already done for you. You have your criteria already done for you. You have your list already done for you, and you'll have your rebalancing done for you by simply just buying the ETF. So if you want a quality tilt, you can get that done without doing all the work yourself. Could bear steepener hurt bigger banks? The same way as inverted yield curve and risk management did in March to regionals, or are bigger banks more recession proof? Where it would hurt the bigger banks is in their lending. It would get more expensive for longer term loans, but probably more damaging than anything is the held to maturity portfolio. And all banks, when they have a balance sheet, right? You have assets and you have liabilities. Liabilities will do a simple bank. You have deposits and you have loans. And because these deposits have no duration, meaning no sensitivity to interest rates, and they have no maturity, they can leave any time. You can't have all your deposits and loans because of that maturity transformation. So you're going to have some short-term cash equivalents, and that's usually your T-bills. And you'll probably have some, because interest rates are low on T-bills, if you have an upward sloping yield curve, you're probably going to try to reach for yield by going further out on the yield curve. You'll also have longer term loans that you make to governments, and that'll be in your held to maturity. So this is available for sale, and this is held to maturity. This is your liquidity portfolio over here. It is over here, this held to maturity, where they're carried at amortized cost. These are carried at fair value. These are carried at amortized cost. So let's say that they mature at this point in time at this value. This is the value they'll be listed at. Even if the value drops to here, this here is called the unrealized loss. So they will have, to the extent of their held to maturity portfolio, unrealized losses. You cannot hedge this. So for hedging, what we'll do is we'll just draw an X through it. You can't hedge it, and you can't do a lot of trading in it because the auditor will say, well, I thought it was held to maturity. You called it that so that you could use amortized cost, so we could reduce the volatility of your income statement, but now you're breaking all these rules. So it can only sit on them. So it'll be the extent that the market looks at these unrealized losses and cares about them. And if they do care about them, then that's where the negative will probably come from. There will be unrealized losses because yields have gone up over the quarter. There will be greater unrealized losses. That's a fact. Period. End of story. The variable is how's the market going to react to that. Now, the market is already anticipating that that's going to be the case. So the prices that you're seeing are probably reflecting the preponderance of that interpretation, or the preponderance of that evidence, and whatever price we have, that's the interpretation that the market is probably applying. Where does it go from there? That's the variable. I don't know. I mean, I've seen companies report earnings and they knock it out of the park and they raise guidance and it sells off, and you're left scratching your head going, well, what is it this time? What sentence did you not like in this whole thing? And I've seen some companies lower guidance, cut their dividend, have a terrible quarter, and their stock price is unchanged, and maybe it even goes up a little bit. So the question becomes, well, did it run up ahead of earnings? Did it sell off ahead of earnings? A lot of it is interpretation. And you can only come up with your story after the price move. It's a tough game to play. Great time to lock in the dividend. My TLT position has taken a huge hit with my average being near 99s. What I do now is that on every Wednesday I sell 2 data expiration cover calls at the premiums between 25 and 27. That's how much TLT pays in distributions monthly. Yeah, I think they're on 28, 29 cents. So this way I get about 5x the dividend each month. It's a bit risky because TLT could have a big move on the day of expiry or something, but it gives me satisfaction lowering my average in manufacturing a dividend. Well, you recognize where your risk is. Your risk is that you sell these 2 data expiration options and TLT rises above that, which means they'll either be called away from you, or you'll have to cover that with a loss. And depending on how much it moves, it could wipe out the last 10 that you did, right? I mean, especially if you're selling it for 25 to 27 cents and you got to cover at $1.50. Or maybe you have a stop at 35 cents, something reasonable, or stop at 40 cents so that you don't lose too much. But that is the risk there, is that they get called away from you. And the higher yields go, the closer we get to something breaking. The debt has to be serviced in both Canada and the U.S., and it's significant. And the higher or the longer yields stay higher, the more burdensome it's going to get from a fiscal side. The central bank is not unaware of this. However, they have a mandate. Their mandate is not a balanced budget. Their mandate is not the fiscal side. Those are our elected clowns that are in charge of that. So we have very little hope there. All we have left is a central bank and a group of people who are notoriously bad at forecasting. There are analysts working for funds and large banks that have a much better track record of forecasting than the central bank board does, than the FOMC does. They are probably some of the worst forecasters out there, but have the single most power in the economy. So they're not unaware that the fiscal is going to be a problem. So higher for longer is a problem. Inflation is a problem. However, if you can break something, and I'm sure at night when these guys go to bed, they're hoping that when they wake up in the morning, something somewhere in some part of the world broke and is enough to create a global recession and solve their problem. Because nothing solves inflation like a recession. Nothing solves high interest rates like a recession. A recession is the answer to everything that they're trying to solve at this point in time. So I'm sure they hope for this to happen. I'm sure the fiscal side is saying, with the interest rates climbing, I hope that there is some solution for this. And nobody wants to do the hard decision. They're hoping somebody else does the hard decision. So the higher yields go, the more likely we are, the higher the probability that something significant breaks somewhere. There's a bloodbath with TLT and this bear steepening. Yes, and here's the thing. Bear steepeners at elevated levels are quite rare, right? So this has been a weird year in both beta and duration, that we're getting the least probability outcomes happening and the weirdest things happening. It's a difficult year for macro. I'll tell you that. Um, I got into TLT at 102 at 20%. Honestly, wonder if rates at the long end will remain somewhat elevated even if a recession hits due to global changes in inflation expectations in the long run. Price action seems really weird though. I'm based in Australia. Also realize that the very thing that would make TLT go up would also make the currency move against me. If TLT goes up in an orderly fashion, you're right. If TLT goes up, if some pressure eases off and TLT starts going up, it'll probably be because you have a risk-on attitude, and treasuries are now seen as risky for some reason. The U.S. dollar would drop a little bit. However, if it is something breaks and you have a flight to quality, what will happen is money will rush into the US dollar and the central bank will drop rates and bond yields will go up. So you'll have the US dollar and bond prices going up at the same time. In times of crisis, that correlation is almost 100%. It's extremely tight. So what we don't want is just an orderly, slow move forward where inflation comes down, rates are going to be higher for longer, the US dollar starts dropping, then yes, that is probably a bad combination for where you happen to be. But it's more likely than not that the adjustment to higher will be difficult for many firms. Also this morning, before I started, I noticed in the US 75,000 employees on strike at Kaiser Permanente. Labor is infected now with the results of UPS. Hearing that UPS drivers on average, all in benefits, retirement, everything, 150,000 a year. Workers are lining up for this. Unions everywhere are mobilizing their people, saying we're striking. Either we're demanding a lot or we're striking. Enough is enough. Labor's share of GDP needs to rise. And I've said this point many times over the last couple of years that the share of corporate profits or corporate profits as a share of GDP, you have a long period of time, a mean reverting level of around 6%, have jumped to about the 11 to 12% range and have been there for the last decade or so. It's a mean reverting series. So when you have that much going, that much of GDP going to corporate profits, labor is going to start at some point looking at that saying, how come we're not enjoying this? That's what makes it mean reverting, is that the boss can only make so much money for so long before the employees say, hey, if you're going to keep driving up in Lamborghinis and Ferraris and we're driving 20-year-old pickup trucks, something has to change. Either we leave or you pay us more. I think that with these strikes going on, that in itself is going to be inflationary. The central bank can't be unaware of this. And, you're seeing it UPS, you're seeing it with the auto industry, you're seeing it, you saw it in Hollywood now, you're seeing it with healthcare workers. Wages are going to have to go up. And if companies try to preserve their margins, the wages going up, then what companies are saying is that, okay, fine, we'll give it to you in wages, but we'll just get it back from you in revenues. If they try to preserve those 11-12% margins, then inflation will be around for a long period of time. What you need is not to elevate interest rates and keep them high for a while. You need to elevate unemployment and keep it high for a while. And that is what the Fed is trying to do. So I think they'd rather have quicker rather than higher for longer. I think they'd rather have quicker. So I don't know if I answered the question, but yeah, it's really weird price action. And if we do get something breaking, your US dollar and your fixed income holding will both go up at the same time. Why depreciation after tax is added back to EBITDA? Added back to EBITDA? Why would you add it back to EBITDA? EBITDA, you haven't subtracted it from EBITDA. Why would you add it back? No, it's not added back to EBITDA. to calculate free cash flow to the firm. I don't know what you're looking at. I don't understand the question. It is wrong in the first sentence. It's wrong in the first sentence. So I'll pass on that. I don't know where the question came from. Last week's Q&A, you highlighted the issues with asset allocation optimization. Could you please share your thoughts on portfolio construction for a long-only equity fund focused on a single region? Well, if it's a long-only equity fund, the portfolio, the strategic allocation is simple: 100% equities. There, done. And then, of course, whatever mandate you happen to have. Let's say you have already picked 100 names from different sectors that tick most of the boxes considered. How would you go about picking the top 30 or 40 and their weightings? Well, what are you trying to get done? Is it you got 100 stocks that meet your criteria? You pick the top 30 or 40. Well, you've just said it, the top. Pick the top 30 or 40. Done. If it matches your criteria, construct some kind of index where you weight each of the factors. Let's say you have 1, 2, 3, 4 different factors they have to meet. We'll weight them. Say this one, I'll weight these two 40% each, and I'll weight these 10% each, and weight their scores and take the top 30 or 40. That's it. How would you know if you're wrong on your TLT position? If you take a loss. You don't know that you're wrong until after the fact. Like, you don't know that you're wrong. So how many games have you watched where the winning team was initially losing, right? I mean, how do you know they're going to, at what point do you know they're going to lose? Like, how do you know? You don't. All sorts of things can happen, right? How would you know if you're wrong? You wouldn't. You wouldn't know until after it's over. So let's say I buy something at 50 and it drops to 49. Am I wrong? I don't know. If I buy it at 50 thinking it's going to go to 60, things don't just go like this. They do this. They do all sorts of things on the way to where they need to get to. They do all sorts of things. So how do you know that you're wrong? For the most part, you don't. You have to rely on analysis, and you have to determine whether or not you still think that you're right. Or that you'll be right, or that you'll be okay, or that there's instruments that you can use to lower the risk that you've taken on. But nobody knows, other than T-bills, okay? Other than T-bills, where the return is pretty much guaranteed, nobody anywhere in this industry, no matter how smart they are and how long they've been doing this, nobody knows on day one that they're going to be right. They just feel they're going to be right based on the analysis that they've done and based on history of making decisions under the same criteria. But other than that, who knows, right? I was right on beta, but I was wrong, I should say. I was wrong on beta, but I was actually right. I was wrong because I lost money. I was short, and I said, that's enough. I'm out. I can't fight this AI narrative every single day. It's killing me. I'm out. And then a week later, the market started going down and has been going down ever since. Had I just stayed put, I would be absolutely okay today with a nice little profit. So my analysis was right. The idea that we would just go straight up without ever solving any issue was completely ridiculous, but the market can be irrational longer than you can stay solvent. So how do you know? You don't. You just don't. Any thoughts on the LEI index being down again for August? Yeah, it is got a 100% track record. You know, we've got to move away from this narrative of a soft landing. If we were expecting a soft landing, what we'd be saying is that inflation is not a problem. And if inflation is not a problem, we would think the Fed would be lowering rates. We would be getting a further flattening of the curve, and the 2-year would be dropping. So the bond market, as it sits right now, is not saying soft landing. I don't think that you can get a soft landing. So the LEI, I think, is correct. The curve inversions, I think, were correct. But again, let's go back to the statement about the market being irrational longer than you can stay solvent, right? Quick question for someone who just turned 20 in Canada. I registered my TFSA, FHSA, and RSP. I have around 50,000 to fill these up, so I'm wondering what investing mindset I should take. Maximize your TFSA first. There's no point in using your RSP. You're 20. You have a low tax rate. You would only be sheltering money at a low tax rate to take it out at a higher tax rate. So basically what you're doing is saying, I could pay 30% tax on this money, but I want to pay 53% tax later on in life when I'm successful. Why would you do that, right? You only start contributing, and for your RSP, it's cumulative, so don't worry about it. You only start contributing to your RSP when you start hitting those higher tax brackets. And you may have, at that point, 150 or 200,000 of unused RSP capacity. So you could, for quite some time throughout your late 30s and into your 40s, really use the tax advantage of the RSP by putting all your high taxable income over a certain number, all of it into the RSP. And if you have 200,000 that's unused, you can contribute 200,000 in a given year to reach your maximum. Wait until you have high tax income to use your RSP. In the meantime, use your TFSA. Let's see. Do I take time to scout out equity, snatch up bonds at their highs, or just 60-40? Well, I mean, that doesn't solve the problem if you go 60-40. 60-40, you still have to look for equities. On the 60%, 40%, you still have to put in bonds. So just because you have an allocation of 60-40 does not mean you avoid the equities and bonds. However, I will say at your age, I don't know that you would have the experience necessary to be able to select on your own. So what I would do is I would simply look for government bonds that you can hold with the 40%. So you'll put 20,000 in bonds. Maybe you'll put 5,000 on the short end of the curve. You'll put 10,000 in around the 10-year, and you'll put 5,000 in around the 20-year or the 30-year. And then for equities, I would simply just buy a market index with low fees. And every time you contribute, just buy on the moving average. You'll create your own moving average of that index. Any worries regarding the possibility of bond vigilantes pushing up yields? I don't know if it's if being that the Treasury market is so big, it's not a small country where you could get vigilantes in there. It's so big that I don't know. You'd have to have the preponderance of the market with you on that one. I don't know if vigilantes can actually get that done. I have spoken to two people who are familiar with the fixed income markets. And one of the conclusions is that a lot of clients see this as an opportunity to grab the yield. So what's going on? If there's that many people who see this as an opportunity to grab a yield, the higher yields are not investment driven, meaning that investors are not fleeing the long end of the curve for a better place to be. And if it's not investment driven, it must be operationally driven. Which means that money is coming out of the longer end of the curve because that money is needed for something, whatever it happens to be. I think there's a combination of things. It could be I'm not going to say the, as in it's the thing, but a thing that could be going on is you have retirees, right? You have the retirement generation that started retiring in 2010 at the age of 65, and that will last all the way to 2030 as the baby boomers retire because they were born from 45 to 65. So you'll have this 20-year span. We're in 2023 going into 2024. These 65-year-olds are 78. Some of them are dying. and you have the inheritance that the kids are getting. And when the kids get the inheritance, if there are financial assets in there, they're probably selling them off to meet any tax requirement, and then using that to buy stuff, right? Because that's where happiness lies, right? Is in more stuff. If I got more stuff than you, I must be happier. So you got to run to the mall and buy stuff. More stuff. Stuff. I need stuff. So this is more operational than investment driven, because you've had the inheritance, you had some bonds. Chances are somebody 78 was probably mostly in fixed income. You got to pay the tax on that, so you're going to have to liquidate some of these holdings. You have to sell the house, liquidate some of these holdings, and then these young kids, or these 30 to 45-year-olds, let's say, now have cash. And are probably doing something like that. So being that we have a wealth, the biggest amount of wealth ever transferring generations between 2010 and 2030, actually you could say 2020, because they're hitting 75, the mortality rate probably increases significantly past 75, that we're entering maybe a 10-year period of massive generational wealth transfer. You could have something operational like this going on. So that is one reason given for what we're seeing right now, is that the sellers are, since they got it, are not beholden to what they paid for it. It was free money for them, so it's not as if, well, I bought it for, 98% of its face value, and now I got to sell it for 72% of its face value. They don't see it that way because they didn't buy it for 98%. In their minds, their cost basis was zero. So it's just a gain for them. So they're indifferent to where the price happens to be. They're just seeing the dollar sign of what they're going to get. So I don't think it's bond vigilantes. That market is way too big. I'm trying to figure out how to make a rule on sizing of active positions with TLT trade, long calls plus added delta from short puts to finance those calls. Are you moving towards a target delta? Do you preset a target at the beginning of the whole thing? Well, it's I'm in the wrong position to answer this, because what I'm doing right now is not what I would normally do. I'm moving into bonds in US dollars because I am leaving Canada, and I do have to transfer securities across the border. And I think sitting at these yields, considering what I have, makes a lot of sense, because I'm basically locking in a fantastic income for the next 25 years. So I'm happy with that. But if I were still in the game, if I wasn't leaving and I was still playing the game fairly, for TLT, that would be a tough call. My motivation would be to sell more puts, and that probably would have been wrong over the last period of time, but I probably would have been comfortable holding it. If I were sitting on a large unrealized loss going into the end of the year, I would be selling TLT, making it a realized loss, and then just buying a US Treasury with the same duration as TLT, so that I had the same upside. And if you do that, if you sell your TLT, you'll get a realized loss, right? And then you move into a US Treasury, the 2048, let's say. It has the same duration as TLT, so that if interest rates did drop, this would increase. Not only does it have the same duration, it has about 100 basis points higher yield, because there are no management fees and no attempt to keep a constant duration on these. So you do a little bit better over here, and you get the realized loss. Well, the realized loss has a tax savings, right? The realized loss has a tax savings, so that's an automatic return right there. So right away, I minimize my loss by grabbing these tax savings, and I've really moved into an identical security that is not the same security, so the wash sale doesn't apply here. So I would probably be doing something strategic in that sense. But I think I would have a hard time not buying more. I would have a hard time not buying more. Yeah. When you take positions in individual stocks as opposed to ETFs, do you have a target price in mind? Not really. Not really. Target price is hard to come up with. It's really just a best guess. A target price is really just a best guess. What I have in mind is are the factors in place for upside movement and value creation for the company, period. Let's not worry about the stock price. Let's worry about value creation. Are the factors there for value creation for the company? If so, then the value of that company will increase. The second part of it is, will the market recognize that the value of the company is increasing? So will the value of the company increase, and will the market recognize that that is happening? In between those two statements is a catalyst. So you can say, I think this company can add a lot of value over the next 5 to 10 years. What catalyst is going to happen so that the market recognizes the same thing? Usually that catalyst would be earnings, such that earnings start coming in, and after a couple of quarters, the market starts saying, look at this, here we go. So I don't know that I have a price target as much as just a belief that there's upside. And then once it starts going up, I'll decide at some point based on the speed at which it went up. Like, for instance, I was in the home builders last year about this time when they were just under pressure. Remember last year at this time we had the massive sell-off that went into mid-October before we had a rally into the end of the year. And then we had the rally into the end of the year, and then home builders continued to rally 40, 50, 60%. They went too far, too fast. And if you had been listening to market updates a couple of months ago, I was saying, look, I'm lowering my position in the home builders because it's just been too much too soon. So there was no price target in mind. There was a long-term idea that, okay, I think this can get to 120 or 130 over the next 2-3 years, and I'm buying it at $80. And it got to 120 in less than 6 months. That's just a little too much too fast. So at that point you say, well, I'll take my money. But had it gone up at a slower and slower pace, I probably would have added more on each earnings call after they confirmed that they are in fact on that path. Why do you think duration will outperform beta if the market consensus for rates is higher for longer? Well, I don't think that that duration will outperform if that is the outcome that we have. What I do think is that higher for longer is going to crush company margins. It's simply going to do it, because a lot of these interest rate swaps are going to, every day there's interest rate swaps that are maturing every day that are being reset at higher rates. In fact, some 10Qs I've looked at, some companies have said our swaps have matured. We have not entered into new swaps. So they are actually taking the other side of the position that they're betting that these are peak-in rates. Well, if it's not, they have no swaps in place, which means they can only get hurt. So I think that duration will outperform in a higher for longer rate regime, not in the higher for longer, but in what higher for longer will do, which will break something somewhere. It always has. It always has. That's the point of it, is to break something, is to lower demand and raise unemployment. That's the whole point of it. That's how they work. It's not a question of the central bank raising rates just to make everything more expensive so that consumers buy less of other things. It is to particularly destroy demand by killing employment. You've got to raise the unemployment rate, because if you give most consumers in America a paycheck, they will spend it. You cannot convince them to save with higher interest rates. That's the economic theory, that if interest rates are high, consumers will make a choice. the intertemporal rate of substitution, that, oh, well, hang on a second, I should invest my money now because rates are nice and high, and then buy what I want in a year when I can buy it with fewer dollars and make some money. Nobody really engages in thinking about the intertemporal rate of substitution. They got money in their pocket, they head to the mall. If you want to kill demand, you must stop that paycheck from entering their pocket. That's it. That's it. And that's where I think duration outperforms. Do you know of a Canadian equivalent to TLT? No, I don't. Because I don't have any Canadian bonds on my own. And if I did, I would buy the bonds directly. Which, coming into December, I will be buying bonds. Curious as your thoughts on CNQ in the E&P space compared to Oxy. I'm sure you've heard the bull thesis: long life, low decline assets, friendly shareholder capital return program, deleveraging, relatively high free cash flow per year. Well, that's almost every oil company now. Canadian and ONG just seems to value at a discount. Well, you have to look at the quality. It's not just what it's doing. You got to look at the quality of the oil that it has. So light sweet is fantastic. And that's what Oxy has, light sweet crude. If it's Canadian, it's doubtful it has that. It's probably heavy sour, which will sell at a discount, always at a discount, and it's the marginal field. So it's not as, it doesn't have as long a life as light sweet crude does, because as demand for oil drops, it's the marginal fields that will go down first. So when you say that it is long life, low decline asset, are you sure about that long life? If you take the recovery rate, if you say, well, based on its production and its proved reserves, it's a 50-year oil field. Yeah, but no oil field is a 50-year oil field anymore, especially marginal oil. It might be a 5-year or a 10-year oil field, right? You got to think about that, because as you put more wind farms out there, more solar farms out there, more electric vehicles on the road, if you get a global recession, you will get a drop in demand for oil. Oil demand, some believe we're already at peak oil demand. Oil demand, as it starts declining, it's the marginal oil fields that get shut down first, because the proved reserve becomes uneconomical at lower prices, which means you have huge impairments coming up. So be careful. Look at the quality of the oil. The longest life fields at this point in time are going to favor companies that are producing light sweet crude. Let's see. If you were staying in Canada, would you continue allocating to TLT and playing options with it too? I think I would. Yes, I do. I think I would. Or would you have begun transitioning in 20-year? I would have done that if I needed the tax break at the end of the year, because it's a capital loss. So I do have capital gains. I've been lucky enough for most of the year in my micro plays. My macro plays have sucked. My God, they've sucked. Beta and duration. But my micro plays have done very, very well. I've been lucky enough on my micro plays that I still have a capital gain going into the end of the year, so I'm going to owe the Canadian government some tax on that. At that point, if I were still playing this game, I'd probably have more capital gains at this point, because I gave up a lot of opportunities that I saw, and it would have worked out, but I didn't do it. Only because I do have to liquidate. It's just a curious place that I happen to be in. Going into the end of the year, that's where you start thinking about your tax position. You say, well, I'm sitting on this capital loss, and I have these capital gains, so I'm going to have to part with money unless I can get my capital gains down without it costing me anything. There, moving out of TLT into the 25-year bond, it would be a no-brainer for me to say, but it's not going to cost me anything, and I don't give up anything on the upside. I give up nothing on the upside, and I get a higher yield. I'll take it. And if I were staying in Canada, my withholding from the U.S. For interest rate is 15%. after the 15%, I would have said, well, I'm indifferent on the yield now. With TLT, I still would have lost based on the U.S. withholding, but you lose on the dividend. They withhold 15% there. So I would have seen that as a wash and saying, well, I'll lose 15% either way. I get a higher yield with the bond, and I'll lower the capital gains tax I got to pay in April. So I would have moved into the 20-year Treasury or the 25-year Treasury purely for tax purposes. Yeah. If you're concerned with withholding tax on U.S. Treasuries, why not just buy strips? Because I'm not sure how strips are treated. So I've got to be careful about the strips. Depending on where I'm sitting, in what account I'm sitting in, and how it's classified, there might be a limitation. I was able to grab 2043s at over 5% last week. Happy to take that duration too. Also for taxation on yield to maturity. Beyond what's represented in coupons, is that not generally considered interest income? Taxation on yield to maturity beyond what's represented in coupons is not no. On well, that's the point with a strip, right? If you're taxed on it, 100% of it is deemed interest. 100% is deemed interest because the thinking is if yields are at 5%, if you bought a bond that day at par, it would have a coupon of 5%. So that the strip itself is in fact a zero coupon bond that should have a coupon of 5. So you would have an interest rate. You'd have to amortize that interest rate every year on your taxes. It's not a capital gain. Whereas if you buy an extremely low coupon bond, then you're only taxed on the coupon. The rest is, in fact, a capital gain. Being that the U.S. will have 30% withholding because there's no tax treaty between the U.S. and Costa Rica on a 1 point, I think I grabbed some at 1.375. I'm looking at 41 basis points withheld, roughly about 41, about 40 basis points, 41 basis points withheld. And I was grabbing earlier, I think yesterday, I grabbed 5.15%, 5.15. So my after tax is sitting around 4.6, 4.65. After tax, I got a 53% tax rate. In Canada, I'd have to get interest income in Canada of 10% to walk away with that after tax. So what I'm getting right now is the equivalent of buying a Government of Canada bond that pays 10% interest, a 10% coupon at par. That's the equivalent of what I'm getting on an after-tax basis. Doesn't exist in Canada. Doesn't exist. Which means I'm getting a return that I could never get in Canada on an after-tax basis. Let's see. Now here's the other disadvantage of the strip. I'll just say this, that the coupon bond has, that the strip does not have, and this is sort of an afterthought, but you bought the strip and it's going to mature at this point and there's no coupon along the way, and if you're outside the country, you may have no tax. There may be no tax. I'm not 100% certain on that, but let's just say that that's the case. And let's say that bond yields kept going higher, which means the price of this on the way to here did this first, right? Did this first before it did that. You have no income coming in on which to buy at the lower prices. You have no reinvestment income, so that means your yield to maturity is the yield to maturity that you bought it at. So if I have a coupon paying bond, it will over time mature. That's the amortization curve, but it may do this before it gets there, right? So because I get a coupon here, I can buy more here. I get a coupon here, I can buy more here. Coupon here, buy more here. My yield to maturity will be greater than the yield to maturity at time zero. Because I'm reinvesting at higher yields. So I will outperform over here versus what you're doing. Even with the withholding, I'll still outperform whereas you don't have that. So one disadvantage of it, unless you're willing to continue buying strips at regular intervals. What's the best way to balance incentives in currency exchange versus question about taxes? What's the best way to balance incentives in currency exchange versus tax rate? I don't understand the question. I don't know what it means. TLT is structured to have constant duration. If yields fell, would you outperform if you just bought a 20-year bond? Hard to say. 20-year bond won't have the same duration as TLT. So you'll have to get to a 25-year bond at least to have the same duration. TLT tries to have a constant duration, whereas your 25-year bond every day will have slightly less duration. Almost immeasurable, but every day that goes by, its duration will be less and less and less. So every day becomes less and less sensitive by a very, very small amount, but mathematically it's not zero. Okay, so every day, mathematically, it's not zero. It will have less and less sensitivity, but it's a 25-year bond. I mean, even if it took a year for yields to go down, or even 2 years for yields to go down, you're not going to be that far off of where TLT happens to be on its duration. And if you reinvested the higher yields, you'd probably do very well. You'd probably, I wouldn't say do very well, but the price reaction would probably be in along the lines of TLT, but you'll have the higher yield. This is insane what's happening on the 30-year. Yes, it is. Another 11 basis points overnight. It almost appears like a squeeze on ZB. Well, that's just a futures contract, right? And the futures contract has an underlying, and the underlying is probably not a 30-year bond. The underlying for ZB is probably, I guess if we look on CME, what the underlying is probably a 16, 17-year bond. So I don't know that the futures is going to get that done. But it couldn't possibly be that. There you go. Your hypotheses on oil is interesting. We'll see what happens if oil prices abate a bit. And as I'm doing this, oil prices are down almost $2 a barrel, $1.50 to $2 a barrel, and bonds are up. TLT is up. So there seems that I'm not saying it's 100% of the reasoning. But there is something there, along with what I said earlier about the inheritances and the children getting money and being insensitive to the original purchase price. Let's take a country that has to import its oil. Almost all trade in oil is denominated in U.S. dollars. So this country has to come up with U.S. dollars. So there is a distributor in this country that then sells, or let's say it's a refinery that produces gasoline and then sells it within the country. Well, the refinery has to pay for the oil. So it goes to the bank and says, I need U.S. dollars. That bank then calls it from the central bank, and the central bank has reserves. And the central bank has to have reserves because there is a certain amount of trade that this country does with, and we'll call it rest of world. And there is a basket, there's a certain number of countries that it does trade with, and they have different currencies. So the central bank will hold a basket of currencies, trade weighted, so that it can facilitate international trade for its own domestic market. Well, it has reserves, and those reserves don't just sit in on a shelf. They're always in some security somewhere. Depending on the demand for U.S. dollars, it's going to have to sell some of its reserves. And a central bank is going to want a return on what it's holding. So chances are, most of the times with upward sloping curves, it's going to be sitting up here somewhere. Because in times of stress, it doesn't have to worry about liquidity. Okay, in times of stress, it can always open up swap lines with the U.S. central bank, with the Fed. So liquidity is not going to be an issue because it can solve that. So it'll probably be somewhere up here. So as the price of oil goes up, as the U.S. dollar goes up, you need more and more of your local currency to get this done. You're going to have to sell something over here, which will at the margin push the yield up. because you're taking your, well, let's see, you have these US dollars that are sold by the central bank that finds its way to the bank, that finds its way to the refinery, that finds its way to the supplier. Now the supplier is getting cash, is getting US dollar cash in, but it doesn't have all of that cash because it has expenses every week with employees. So it gets some cash and it puts those cash into what are called cash equivalents. And then employees go and they spend that money with other firms as well. And these other firms have revenues that come in that either go into cash equivalents or maybe go into real assets. So it's coming out of the long end. Some of it may show up at the short end when it arrives at the destination. Some of it may be spent on items somewhere else, but you have a whole bunch of little raindrops of money going on in the economy after that. That is not being replaced in the long end of the curve. So there is something to the oil trade, that if you see the price of oil going up like this and you see the US dollar gaining strength, but you're seeing bonds and equity sell off, the question is, money is going into the US dollar, but it's not going into financial assets. Where is it going? And this goes back to the conversation I had earlier with someone who said it doesn't seem investment related, it seems operational related, and gave the story about could be the inheritances going on. So maybe all of these things are just happening at the same time. I've read the speculation the Chinese slowdown is causing them to no longer be a buyer of US treasuries. Could this just be banks in China all tapped out at the long end of the curve? That could be part of the story as well. There's never just one item. Sometimes there's an item that causes a small displacement, but when you have something significant going on, it's usually 3 or 4 things all happening at the same time, which makes it even more so. So suddenly you get a lot of people saying, "This is insane. This is crazy." It can't just be one story that's causing this. It can't just be the clowns in Washington. We've had clowns in Washington for years now. And this was never a problem. So it must be something more than that. I'd expect pension funds to be more than happy to grab these yields. And they are. Job done. For a lot of pension funds, for a lot of endowments, for a lot of insurance companies, especially life insurance, this is job done. This is especially insurance companies that wrote annuities and wrote policies during a low interest rate era. This is job done. Move into the 30-year bond and let's all go home for the next 30 years. Job done. But yes, the ballooning of yields seems somewhat and somehow correlated with the US dollar. And I think you're right on that, which sort of gives us an idea that if we look at the rising prices, because usually if the US dollar gets stronger and trade is denominated in US dollars, the commodities that are denominated in those dollars drop in price so that they stay constant in Australian dollars, as they stay constant in euros, that drop in US dollars. But when you have oil, energy rising in price, and the US dollar rising at the same time, that means that energy gets even more expensive than just the price increase in importing countries. And if trade is denominated in US dollars, there's a demand for US. I don't know if anybody has access to this. I tried finding it on what the for a cross-currency basis swap. What's the basis right now? If I could find that, it would not be surprising, or at least I wouldn't be surprised to find out that the basis is extremely rich for those with US dollars. That the basis is really high. I don't know, but if anyone has that information, please share it. I've been in a high delta short put ZB position. I've noticed another thing unexpected. The spread on the security has typically between 264 and 464, but immediately after jolts it widened to 22. Could this mean that CME is holding more risk than it'd like? No, they don't hold risk. They don't hold risk. They're counterparty to every contract, which means for every long they have a short and they have margin. So they don't have risk. The clearinghouse has no risk. That is just the market maker that widened it because there has to be some firm somewhere that makes a market in it. If there is no market for it, somebody has to make a market for it. What are your thoughts on oil? I think it's wet and it's black. Do you think it do you think it stays at these elevated prices for a while? I think that $40 oil is only possible in a massive global recession, because you've had prices going up on oil, and if you look at the rig count in places like Bakken and Permian, they haven't gone up. In fact, in some places they've gone down, and you've had some shale oil companies say we have no intention of adding any more rigs, even if oil prices go up. In fact, we're probably going to reduce our rig count, because you have governments all over the world threatening to slash their throats, wanting them out of business. There is zero motivation on the part of any oil company anywhere to spend any money on any new development, or at least any significant money on any new development. And if they're sitting on a big field that they can easily drill more wells and produce more oil, why would they? Why would they? Why not? Why not just keep these prices high? So there is a motivation, not just, I think, unspoken, but now actually being spoken right out, that we're not going to produce more oil, even though we can. We're just not going to do it. Well, this is the problem with policies that sound good on the surface without thinking through the unexpected consequences of it. Is that you need oil as a transition. But listen, let's say you need an employee for the next 2 months as a transition employee. You need them, and you need them to continue performing. Would you tell them they're a transition employee, or would you wait till the last day? If you told them they're a transition employee, they're going to start looking for other things. You may not get them for those 2 months. Well, this is what governments did. They told the employee that they're a transition employee and that their notice is on the wall. Oh, and please continue to invest shareholder money right till the very last day. Come on, right? So governments at this point have done it to themselves. They have done this to their own citizens through a general lack of understanding of how investment decisions are made. I hold TLT for duration. I'm Canadian, and the view of the Bank of Canada will need to cut rates before the Fed, so I've added my duration exposure by dipping my toes in some Government of Canada bonds. I'm uncertain if I should continue adding to my Canada bonds or convert more CAD to US to continue building my TLT. Well, the exchange rate's ugly right now, right? Or start a new UST bond position. Still a bit new to fixed income, so my particular concern is the BOC cuts rates and long end yields don't drop. I'm unsure if that's even a realistic outcome with bonds in any instance when central bank cuts rates. Am I worrying about nothing, or is this a valid concern? Any other risks I should think about Canadian bonds? Well, I will say that the Canadian economy is more interest rate sensitive than the U.S. economy. And we can see that because just look at the absolute level of yields. Our 10-year is sitting around 4%. The 30-year has certainly got a much lower yield than the 30-year in the U.S. Because it's believed that you're going to need higher rates in the U.S. to get anything done, but Canada's far more interest rate sensitive. But I think the new deputy governor gave a talk in Vancouver, was it yesterday or the day before, that he said that he's expecting a second round resurgence of inflation, primarily due to companies frequently raising their prices, pointing out that is inflationary. Well, yeah, of course that's inflationary. When companies raise their prices, that's how you get inflation. I mean, come on. And if that's the case, and if that's the sort of tone in there might be a faster move to cause a recession. But a recession in Canada without a recession in the U.S. is sort of a wasted recession. I mean, it's just a wasted recession. We really want to go along with the U.S. on this one, but the other report I saw was out of Toronto from the Real Estate Association, showing that the housing market, based on the sales to listing ratio, the housing market is now firmly a buyer's market. Between 40 and 60%, it's a balanced market. Above 60%, it's a seller's market. And below 40%, it's a buyer's market with this index that they use. And the index is at 28.6. The sales to listing ratio, 28.6. In other words, sales have been dropping, listings have been increasing dramatically. It's now firmly in a buyer's market. However, CMHC the same day came out and said it will take $1 trillion in 10 years to fix housing affordability. Who do you believe, right? So one thing I do know for sure, every day walking into a bank branch somewhere is a homeowner renewing their mortgage for the next 5 years at higher rates every day. So I seem to think that given where we are, given the elevated risks, and just given the basic math of time value of money, you cannot ignore the math of time value of money. Just given that, the preponderance favors duration over beta. Looks like you're pretty confident on duration trade. However, in markets, you can never be confident. No, you can have confidence, but not be boldly confident. So just wondering if you ever envisage a situation where the duration trade does not work, or even if it does after a long time, in case it takes a long time. Well, so you have to determine what it is you're doing. Are you trading and investing to make an income this year? If you are, well, then you have to worry about these things, right? I mean, if your average holding period is 3 months to 6 months, well, then this might not be the trade for you. But let me just explain the beauty of bonds here that you don't get with stocks. Let's take a bond at 100 and let's take a stock at 100. There's your stock, there's your bond. You buy it at 100, it has a 2% dividend, and the price starts dropping. There is no future value on that stock. There is no date in the future that says, here's your $100 back. There is nothing, which means you really have to be on top of that company because it can go bankrupt and disappear. Government bond can't do that. You buy it at 100. At some point in the future, it's going to be 100, and you're going to get a coupon on it. So even if it drops in price, as it starts getting closer to par, it will be pulled back to that 100. You cannot lose. Let's take a timeline. You're 30. When do you need this money? When you retire at 65. Are you trading for the next 3 to 6 months, or are you investing for your retirement? If you're investing for your retirement, you don't care. I mean, you really don't care. If you buy a 30-year bond at 30, it'll mature when you're 60. It'll mature at 100. 30-year bonds right now are going for about 50 cents on the dollar, 50%. So, well, actually, a newly issued one would be selling for par, but you'd be getting 5%. So let's take the 25-year bond that I've been buying. It's going for about 70% of its value. In fact, if you look at a 17-year bond, you can get it for about 54% of its value. But let's take this one. You're buying it for 70 cents on the dollar, and 25 years later, you're going to get 100 cents on the dollar. Now, you may think, but that's a long time to wait. This bond here, this 25-year, has a 3% coupon. That 3% is on the face value. That 3% is on 1,000. So you're getting $30, but you only paid $700 for it. So your cash yield is quite nice. Your cash yield is quite nice. And somewhere in the next 25 years, you're going to have a recession. You are, and yields are going to go down. So with bonds, I know that this is my future outcome. So if I have a long-term investment horizon, I look at this and I say, I'm good. I'm good with that. Good enough. And my cash yield is going to be very nice. However, if I have stocks, it has to go up. It has to perform. Everything has to come into play. And if it starts dropping in value, I have to start worrying, do I take my loss? Do I take my loss? With the bond, I never have to take the loss. If I'm comfortable today, and the 17-year bond was yielding 5.15 yesterday. The 25-year bond was yielding 5.08. And if I'm comfortable saying I can lock in 5% a year for the next 25 years, guaranteed 5% a year, where the last 15 years 5% was a dream, you had to go into really high yield to get that 5%. I can get it from US Treasuries. I can get that 5%. If you have a long investment horizon, it should not be a concern to you. But if your average holding period is 3 to 6 months, and you're trying to make money on every trade, then you need to trade small and trade often. It's possible. It can be done. It just depends on what it is that you're trying to do. Let's see. Have you thought of a situation where rates go to 8 or 9% and then go back to 4 or 5? It doesn't bother me. Again, I have investment, and that investment has cash flow, and I have income, and that income provides cash flow. So if, again, I know that in the future I'm going to get this, and I'm buying at, let's say, 70 cents on the dollar, here's the constant yield price trajectory. That's what it's called, a constant yield price trajectory, and otherwise it's the amortization curve. Well, bonds can do this, right? But they will do this. They will always be at this price at that point in time. And because I have cash flow, it doesn't matter to me. I have cash flow. Reinvest, 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 reinvest. Thank you. Reinvest. Thank you. Reinvest. I can reinvest along the way. More than likely, I'd follow a laddered strategy, which means that I have the August 2048 bonds. Once we get into November, then I will switch to the November 2048 bonds for my cash flow reinvestment. Once we get past November, I will go to the February 2049 bonds for my reinvestment, always maintaining a constant duration. Or, well, it won't be a constant duration because I'll have a whole bunch in the 2048 that won't be maturing, but I can reinvest at lower and lower yields. So if it does drop to 8 or 9%, the price drops because it wants an 8 or 9% yield, I know I get 100% over here. So all that's going on is if I'm saying I'm comfortable with 5% and the market gives me an opportunity to now get 5.5% and now get 6% and now get 6.5%, as I get cash flow from my income and cash flow from the reinvestments, I will continue to reinvest. Why not? So think about your investment horizon and what you're trying to get done. Understand that if this were 7 years ago and you had a long investment horizon and somebody just opened a door and said, psst, psst, I'll give you 30-year treasuries at 5.15%, the lineup that would have occurred at that point in time. Now, if you think you're never going back to an interest rate regime like that, then maybe this is not for you. But if you think that this is a temporary deviation, and that we'll go back to that our future is going to look like Japan, where we have deflation as the backdrop and not inflation, because technology is deflationary and we are getting into a more and more and more technologically driven world, then deflation is more likely the future, not inflation. You're going to look back in 2 or 3 years and say, I could have had 5% locked in. What's your investment horizon, right? Let's see. I have a question regarding the materials for CFA prep. Limited budget for level 1. I have to choose. Oh, I already answered that. It is likely that the 10-year yield rises. REITs will have to decrease their dividend. Why? Why would they have to increase their dividend? You have to understand what mortgage REITs are doing. They hedge out interest rate risk, and they lever up the spread. Now, as they reinvest in new mortgage-backed securities with their cash flow, they're reinvesting at higher and higher spreads. So it is not their net income. Their net income is meaningless because the net income has fair value losses. Because since they have a whole bunch of mortgages that they hold on their income statement, these are not held to maturity. These are not amortized costs. They are fair value. You're going to have a whole bunch of fair value losses on the income statement. So your net income is going to be terrible. You can't look at the net income. You have to look at the net interest income plus dollar roll margin. Dollar roll margin. And look at agencies. They've never been higher. I think you get 2, 3, 4 quarters in a row where they, you're not setting records each quarter, but they're compared to their history at multi-year highs on the cash flow, and the dividends come out of that, not the fair value losses, because those fair value losses, when interest rates turn around, become fair value gains. The REITs that they're the mortgages they're holding are agency mortgages, which have a de facto government guarantee. In other words, can't lose on them. What happens to the economy when when bear steepening happens? Things break. It's higher yields raise costs for everyone and slow down economic activity. Period. That's what happens. Why don't we don't have a shortage of housing in the U.S. despite what the NAR wants to tell everyone? We have tons of inventory locked up by investors who are chasing yield when interest rates were zero. Oh, so shadow inventory is what you're saying, is that the inventory is there, it's just not on the market. I think I can accept some of that. You have a lot of investor homes, and you have a lot of properties that are Airbnbs. That if you didn't have such a thing as Airbnbs, you'd have a lot more condos and apartments available. And I guess if you limited the investor side of things to saying, listen, as soon as you have more than 10 homes, you're a particular type of investor, and maybe you can't do something like that. I don't know. In time, we will see that we have overbuilt, especially in places like Dallas, Fort Worth. Also, I've been seeing price cuts all over the place. Yeah. Were you taken by surprise by the rapid and continuous rises in yields at the longer end of the curve? Yeah, when you see that going on, you have to say, well, this can't be just one thing. I get that there's supply coming on the market, but if you look at the auctions, the bid to cover is good. There's demand for it. It's not as if you have a failed auction where they're trying to sell 30 billion and there are only bids for 26 billion and they can't sell it. The bid to covers are there. So it's coming into the market. So it can't just be that. Not these big moves. Not these. It's got to be a confluence of factors happening at the same time. And along with weak hands. Shed light on your confidence in your long duration trade. Because I am a student of economics and the history of economics, I'm confident, quite confident, that my long duration trade at some point is going to pay off. And if it doesn't, it already is a guaranteed winner. If you're buying at yields of 5 and 5.1%, that's what you're going to get. That's what you're going to get, period. I would have to think that there's a possibility the U.S. government defaults on its debt for me to be worried about this. How would you work your way out of trouble with this position? Every day there's something called pull to par. Every day that goes by, your bond gets pulled, incrementally small, because it's 25 years. It's incrementally small, but every day it gets pulled to par. Every single day. Maybe it's only a half a penny that gets pulled to par every day, and then as time gets closer and closer, it gets pulled to par at a faster rate, but it gets pulled to par. In the meantime, you have change in yields that are going to mess you up. But if you have that long-term investment horizon and you're comfortable with that yield, if you can lock in that for the next how many years and you're comfortable with it, I don't need to work my way out of trouble. Time will do it for me. Surprised to see how the belly and the long end of the curve are raising significantly, yet investment grade spreads remain cool as a cucumber. No kidding. Investors seem to be pricing in severe concerns in sovereign debt, but they remain super complacent in corporate debt. Well, that's because corporate debt companies typically aren't run by clowns. Washington is run by clowns. Washington is run by idiots. Washington is just a shit show and a clown show. Investors would never accept that from corporate leadership. You just have better governance in corporations and better management in corporations than you do with government. Government is for people who can't make it in the real world, who can't make it in the corporate world. Well, you can always run for office, right? You can always run for office. And you know, you're not getting enough hours as a drama teacher. You're a supply teacher, a part-time drama teacher. You're not getting enough hours. Have you thought about prime minister? And you make a lot more money. Qualifications? You don't need qualifications. You just need popularity. Just be popular and say stuff people want to hear, and they'll vote for you. Oh, don't worry about breaking things or not being able to do a good job. That's not the point. The point of being in office is to make decisions that get votes, not make decisions that are right for the economy, not make smart decisions, but make decisions that get votes. That's all. So tell people that whatever is going on in their lives, it's not their fault. Tell them they're going to get stuff, and you'll get reelected. That's why I think the market is more concerned about governments than about companies, because companies have merit-based executives. Governments have popularity contest winners. That's it. How would you take advantage of the bear steepening if you think it was about to unwind without futures? Would it be as simple as short puts on short-term Treasury ETFs? Not short-term Treasury ETFs. You go long-term if you think the bear steepener was going to unwind and turn into a bull flattener. Long calls on long-term Treasuries. Yeah, long calls there. You could put short puts on the long-term. You sell the puts and buy the calls. That's just a synthetic or a risk reversal if they're done at different strike prices. Next one, recent spike in yields despite disinflation and FRR topping out. Lots of experts just point to excess supply as the reason. No, as a reason, not the reason. There's never just one thing. As a reason, yes, you have excess supply going on at the same time that you have probably a higher demand for US dollars from energy importing countries, probably at the same time that you have liquidation of inheritances going on from one generation passing to the next. So and at the same time that you have other investors with a shorter investment horizon getting out of duration because they're seeing duration being punished. So I think it's a confluence of factors that you cannot discount either one of them. All of them are contributing to some degree, but I don't know that I'd say that it is 100% supply, but it is a contributing factor. Since you're moving to Costa Rica end of the year, would your market benchmark and inflation expectations change? No, because I'll still be trading the U.S. market. Nothing would change for me there, just the location from where I strike the keyboard. Right? Two questions. What's stopping financial institutions in Canada to issue 30-year mortgages? I believe it's a restriction by decree, either CMHC or a federal restriction, but there are none. You had mentioned in previous video that you chose JP Morgan as the outside manager of funds. Do you mind sharing the factors you consider when making the choice? A lot of times it's who you know and where you have connections. And sometimes when you have connections somewhere, you can get things done better than if you just showed up at the front door saying, hey, let me in, right? 837, you say the Fed is done at the long end of the curve. No, I don't think I said they're done at the long end of the curve. The Fed has nothing to do with the long end of the curve. I'm saying that given what is going on at the long end of the curve, the Fed is more likely done than not. I thought their decisions only impacted the rates at the short end of the curve. No, their decisions impact the entire curve, but they only can set the Fed funds rate. All other rates are derivative or derived from that. In other words, based on what the Fed funds rate is, the market determines what all other rates would be. So it does influence the yield curve indirectly through the level of the Fed funds rate, but it does not make decisions on those things. What is the duration of the bonds the Fed holds? I don't know. They are a hold to maturity on those until, other than the mortgage-backed securities, which they say at some point it may become appropriate to sell them, but they are a hold to maturity. So I don't think their duration really matters. Can the increase in long-term yields be attributed to Fed doing QT? It is a contributing factor, sure, but they are still a buyer. They are a net buyer. So if 100 billion rolls off, 60 billion they would not renew. They'd be in the market for 40 billion. So they are a net buyer, but there is roll off of 60 billion a month. So it is a contributing factor, sure. The market value of all bonds of Fed holds would have significantly come down due to rising rates. Would that accentuate the QT the Fed is trying to do? Nope, because when a bond matures, it matures at par. So no. How are the real rates calculated, and how do we know they are restrictive at 2%? Real rates is you just take, you just look at TIPS. TIPS are Treasury inflation protected securities. Look at a 5-year TIPS and look at what the yield is on a 5-year TIPS. That's a real rate. How do we know it's restrictive? The target for the Fed funds rate is 50 basis points on a real basis. They have a long-term target of 2.5% as we believe their neutral rate, with a 2% inflation target, leaving 50 basis points of real rates. If we look at Fed fund futures now at 5.33, and you look at inflation PCE, which they look at 3.5, you're 183 basis points versus 50. Anything over 50, if we think this is the neutral rate, anything over 50 would be restrictive. Any update on your wheat futures position after a very tough Friday? I was out of wheat quite some time ago. I was out of almost everything quite some time ago because of my move. So, yeah, I was out on that. I'm partially hedged, considering hedging a bit more and rolling the put contract early 2024. Can you man any other sources other than the WASD report? That's the big one. I believe there is a monthly as well, but the WASD is the big one. I saw that IB has 1.125 2040. They do. They are 17 or basically 16-year bonds, 16.5-year bonds. And their duration, because they have a low coupon, I think I calculated the duration to be somewhere around 14.5. As the coupon heads to zero, the duration would head up towards 16.5, because the duration of a zero coupon bond is its term to maturity divided by 1 plus R. 14.5 TLT is 17.6. So when you close TLT and move into this one, while you have a low coupon, you have a duration mismatch, which means if TLT does recover and you're sitting in here, you're not going to recover by as much as TLT would recover. You just have to be aware of that. ZB TLT sure looks like they've lost their minds in the last week. I also sold puts. I started to worry, what am I wrong about here? As it kept falling off new cliffs, still your impression of momentum somewhat matches up with Chicago Fed Goolsby commentary on the long end. Still having a hard time understanding how the 30-year is beyond 2% inflation plus 1.8% real GDP. Also have a hard time understanding why the SEP actually brings, as far as information goes, what the SEP brings. Probably nothing. They are notoriously bad at forecasting. So the yield on the 30-year is ignoring what the Fed is forecasting, because they're just terrible at it, right? Did the SEP forecast bring much to the conversation? Just the only thing that changed, well, I shouldn't say the only thing. The significant thing that changed was, rather than forecasting 100 basis points of cuts in 2024, they're only forecasting 50. Okay. How would you go about establishing a view regarding Aussie-US? Well, your biggest trading partner for the Aussie is China. And as China goes, Australia will go, because it is a provider of raw materials. I think 20 up to 25% of the market cap of stocks in Australia are in the mining sector. So it is a big supplier to China. So as China goes, the Australian dollar goes. So I would start there. Australia has very low debt. Like, debt is not an issue in Australia at all. And I think it's gone like 25 years or something, almost 30 years, even longer maybe, without a recession, which is pretty good. Maybe as India goes, Australia goes. Maybe because India is going to need resources over the next 20 years. So maybe Australia is in that nice little place where they can either send it to China or send it to India, just across some oceans. Yeah. You got to look at the big trading partner there. Do you think the Treasury Department purposely issue more long-term debt now to increase it 10 years so they can affect the mortgage rate and help the Fed? No, that's attributing strategy to Treasury, and Treasury is not going to do any kind of policy at all. I shouldn't say strategy. It's attributing policy to Treasury. Treasury is not going to get involved in policy at all. If there is something to be done on the 10-year to help the Fed, that's got to come from Congress. Treasury would be overstepping significantly if it started doing things for policy outcomes. It would be bad. That's not in their mandate, and they'll never do that. Let's see. What are your thoughts on buying a 100-year Austrian bond? Well, I think it's only yielding like 3% now. It's still rather low. I think it's cheap. What is it selling for? 30 to 35, somewhere in the low 30. So you're paying like 32, 33% of its face value, and it's getting 3%. But depending on the currency risk, if you're comfortable with the currency, then I guess. How liquid is it? You'd have to determine how liquid that thing happens to be. It might not be liquid at all. What are your thoughts on agency MBS and mortgage REITs at this point? I'm okay with them. I mean, I've spoken about them at length before. I don't know what more I can add to it. I'm not concerned with them. If funds are flowing into TLT, why isn't it reflected in the price? Or is it because of excess supply of the long bonds? Well, TLT's price is this: market value of its bonds divided by number of shares. That's it. So it's not as if more money flowing into TLT can possibly push up the price. It would just create more shares. So it's the market value of the bonds that are doing it. So let's say that the market value of the bonds are dropping, let's say 15%, and the number of shares are increasing, let's say 10%, meaning that money is going into TLT because you're producing more shares. You'd still have the price of TLT dropping. So money can go in, but the price of TLT is a derivative, right? It's derived from this formula, the market value of its bonds. It's the market value of the bonds that determine the price of TLT, not the supply and demand for TLT. Let's see. What broker system are you going from and to? Interactive Brokers Canada to Interactive Brokers Costa Rica. Same thing, but you just have to open up a different account. Any ETF which tracks yield curve inversion steepening. I don't know if it's an ETF. It's called TUT. And it's futures based. Foreigners don't pay interest on bonds due to portfolio interest exemption. Never heard of that. There is a withholding. And if I hold foreign bonds here in Canada, let's say I hold UK bonds, my government here in Canada says, you made money, we don't care where you made the money from, you're taxed. If you have US bonds, and you're a holder in Canada inside a registered account, like a TFSA, there is no withholding. In your TFSA, there is a withholding, and in your taxable account, there is a withholding, but since we have a tax treaty, that withholding is only 15%. And then you got to pay the Canadian government on what you get left. If you don't have a tax treaty, the withholding is 30%. So never heard of this portfolio interest exemption thing ever. Are you sure there's a 30% withholding? Yes, I am. That should only be dividends. Nope. Nope. Where can I find schedule of speakers? On the Fed's website, you're going to get the Fed governors. You're not going to get all of the Fed banks. Like there are 12 regional banks for the Federal Reserve System. You'd have to go to each one of their sites to get it. I just use daily. Go to dailyfx.com, and they have an economic calendar, and usually by Sunday it's updated with most of the Fed speakers. Jamie Dimon says Fed to hike to 7%. What do you think his thesis is on this? First of all, that guy doesn't say anything unless it's well thought out. See, he knows that he can move markets. He knows he can. So before he says anything, before he talks, there are conversations about what is going to be said. He can't just go running off at the mouth on whatever he thinks is going on. It's well thought out. So if he's bringing up the idea of 7%, there is some reason why he's doing it. Is he doing it such that it can be avoided, right? By bringing up the idea, is he doing it to hopefully avoid that outcome, or convince other people, or highlight to other people that that's an outcome that should be avoided? People in power, or at least with the power to make sure that doesn't happen? Or is he doing it to encourage the market to get even more jittery, sell off more bonds, to encourage more trading? I don't know. Think about it. He's not just going to say something like that without being aware of his position. And so he knows he can move markets. He's going to be very careful about what he says, and what he says has a purpose. So it's not what did he say, it's why did he say what he said, and you have to attribute purpose to why he said this. Thoughts about frozen concentrated orange juice? None at all. Why is XLU sold off? That is a curiosity. It should not have been selling off. Unless the only condition that you can think of is that, well, long rates are going up. Utilities are going to be valued on the present value of its cash flow. Rates are going up faster than its income will be going up. So its present values will be lowered, and you have to believe there is no fear in equity markets, so that you do not need defensive sectors. So we don't need the defensive sector because there's no fear. Higher rates mean lower present value for this company, but not lower present values for other companies in the stock market of which we want to get aggressive on, which is a contradiction, right? So why did it sell off? No idea. The way it sold off was brutal. But it should not have. Why are you leaving Canada? High tax rates and stupid policies. How you compute the pages felt in the economy so far, 225. How you compute the pages felt in the economy? I don't know what that means. I'm sure that you have autocorrect in here somewhere and you meant to ask something else, because I don't know what that means. With the dollar surging, similar to what it did last year at this time, is there anything you would attribute to the current move in terms of the macro environment? It is odd. U.S. dollar strengthening usually is a risk-off play. Risk-off play, equities down, safe sectors up, and bonds up, but you have U.S. dollar up, you have equities down, safe sectors down, bonds down. It is a head-scratcher of, okay, well, where's the money flow going here? It's hard to follow, because it's just not following a playbook that makes sense. If you had held on to your ES short position for at least a couple more weeks, could you say now in hindsight how long you would have held it until closing? I don't know how long I would have held it until closing. After being underwater for so very long, when you start seeing the trade work out, the motivation is to really, really reduce your risk at break even. So I probably would have reduced my risk at break even. I don't know how long I would have stayed in the game, but in staying in, I know that I would have played it day by day or week by week. What's the tone of the market? What's the conversation saying? And it's it's hard to say what you would have done on the spot had you done something different. What price do you favor accumulating FCX at? This price? With everything going on, copper is holding at 360. That is impressive. Because the last time copper fell apart, it got down to 250, 240, 230. It's holding at 360. So yes, it's under pressure, but copper is holding its ground. That is impressive. So I'd say here is where I'd probably be interested in accumulating FCX, accumulating DHI, accumulating OXY. Oxy's in a good place. Agency's in a good place. GM, I still would not touch. GM and Ford, I still would not touch. I think they're going to get hurt quite badly on this. I think 25 on GM is a reality. Is I shouldn't say a reality, but in the realm of possibility and probability, not an insignificant probability, but a probability. Maybe even sub 25. So I just wouldn't touch them. With the union banging at their door, and you had another big strike today, Kaiser Permanente, now the 75,000. Labor is on fire. Labor is lit up. And when they start seeing everybody getting these victories, they're not going to settle for 20% pay raises. They want 40. They may settle for 30 with a whole bunch of other gifts, but I don't think that I would touch companies with significantly big unions at this point in time. And that takes us to the end of it.